In interesting times in the market. I mean, right now we're seeing this mega PSU rally, for instance, play out because everyone's wondering what is the government's next move, the next so-called reform. First and foremost, before we get down to talking about the market, what is your view on some of these PSU stocks that have rallied so much, and specifically the oil marketing companies, because the sense is that maybe we'll get to see a deal here?
Well, we generally try and avoid the oil marketing companies purely because regulatory interference has historically been high, and we continue to believe that the government will intervene in capping prices off and on. So they look cheap prima facie, but there's no earnings visibility and earnings certainty in these names. The only PSU names we might look at is some of the large public sector banks, but we prefer owning the private sector banks.
Okay, fair enough. Shreyas, hi, good afternoon. So I'm just going through your top 5 holdings. What's interesting is you have 2 insurance names there. That sector is coming up big time. You think there's more value here, even from these levels?
Well, I think we're looking for sectors and companies that are dominant in sectors which have a long runway for growth. And so life insurance penetration in India remains very low. But that said, valuations today are closer to the fuller side, and one has to be cautious at current levels. But we like life insurance from a long-term perspective.
Okay. The other interesting facet is that you've chosen Bajaj Finserv. I don't see Bajaj Finance in the top 5, but Finserv is there. What's the rationale, and what is your overall view? Because there's so much regulatory change that's also going on around the NBFC space. What would you expect from a stock like this over the next, let's say, 3 to 4 years?
Well, coming to how we pick stocks, I mean, we like NBFCs that have run by good quality management, that have a low asset liability mismatch, and are well capitalized, and so in this current environment can actually raise capital. So for us, companies like Bajaj and some other NBFCs meet those criteria. So these are long-term compounders that have created good wealth for investors in the last few years, and the penetration of credit today in the economy still remains very low, and so the the potential for these select NBFCs to grow at much faster levels than the industry average, that argument still holds true today.
All right, so that's the call on NBFCs. If I could broaden the question to banks at large, Shreyas, because what we've seen is some of the tier 2 private banks, they have been slammed down quite a bit. I mean, I'll cite IndusInd as an example, RBL Bank as an example. So when you're picking and choosing banks, what do you prefer? And would you look at some of these names where a lot of money has come off the table?
Well, we like the larger banks who are, especially private sector banks who are well capitalized, and we do prefer the ones who have a slightly more corporate facing book. The issue with some of the mid and smaller banks is that they've grown their asset side too fast in the last few years. RBL is a case in point. And without enough emphasis on the liability franchise. And so we're a little worried, given the smaller size of the book. Any small, any significant corporate, asset quality that becomes an NPA could have a material impact on the net worth of the bank. And so we think that for some of the smaller banks that haven't focused on the liability franchise and raising, having low access to low-cost deposits, it's a risky proposition in this slow economic environment, and so we would prefer owning the larger corporate-facing private banks.
Okay, fair enough. In the mid-cap universe, what are the key themes, Shreyas, that you're now looking at, perhaps for fresh investments after the kind of decline that we've seen in the space?
Yes, I mean, if that's a good point. If you look at the mid-cap and small-cap valuations today, if we roll back a little in time, and this valuation differential was huge at the start of 2018, and that this differential between mid and small caps and the Nifty 50, and today the differential has narrowed significantly. We think the incremental opportunity is in mid and small caps. And but one has to be very careful in stock picking here. We've got to look at the companies that operate in good industry structures, and also management quality is very important. So before we invest, we normally look to meet management and understand their growth dynamics and how much skin they have in the game, and also quality of accounting. As you go down to smaller caps, the accounting naughtiness or accounting shenanigans, if you like, does get a little high, and so we really have to, indulge in good level of forensic accounting before we invest in mid and small caps. But incrementally, yes, the opportunity is in this space.
Okay. Shreyas, the big debate obviously is around the auto space, also auto ancillaries. I mean, one of the foreign brokerages gave out a buy call on some of the ancillary names today as well, for instance. Now, here, after the kind of value destruction that we've seen, are you picking and choosing? And if so, what kind of stocks would be on your radar?
Sure. I think quite a bit of the slowdown now is factored in stock prices of both the auto OEMs and auto part manufacturers. Obviously the slowdown was exacerbated by the liquidity crunch in NBFCs, and we've seen a lot of working capital stress in the OEMs and in the auto part manufacturers. We like auto part manufacturers who have robust relationships with multiple OEMs, who have good pricing power and who can negotiate hard with the OEMs, and who produce not just for India but can export overseas. And also who are, from a medium to long-term perspective, if they're relatively insular from the electric vehicle threat. So I think if auto part companies that can meet some of these criteria can grow faster than the industry average in the coming years. So long-term, we're still positive, because vehicle ownership remains low in India, so we're still positive on the sector.
Okay, what about pharma? Do you have any stocks in your portfolio? Are you looking at anything right now?
We like the theme of offshore earners. So, we do have some pharmaceutical exposure in the mid-cap space. We think there could be increased API sourcing, for example, from some of these smaller Indian companies. And so we do actively look at mid-cap pharma run by good quality management.
Okay, Shreyas, on the market as a whole, do you get the sense that we, at least at the index level, we seem to have made a bottom? Do you expect more money to come through and higher levels from here on?
Yes, I mean, if you look at earnings, I mean that's one of the key misses. That's something we're missing in the market today, is lack of earnings growth. If you look at corporate profit to GDP, that's about 2.3% today, and it's a lot lower from the highs that we saw in 2007 when that ratio was about 7%. So the lack of earnings growth across the system has led to sluggishness in the markets, but there are still some pockets of earnings growth and earnings growth visibility. So in terms of timing the exact bottom of the market, that's very hard to do, and we generally advise investors to stay invested because the long-term potential for India is still very robust. Here's an economy that has a very low GDP per capita compared to other emerging market economies, and if you look at the breakdown of GDP growth, if you look at India's demographics, if you look at capital stock, for example, the number of airports in India, or if you look at electricity consumption, all remains very low. The pervasiveness of technology today has added to increase in productivity, and Modi's strong reforms in the last few years, all combination of all of this should put India on a higher growth trajectory in the medium to long term. And so we're really not looking to try to time the bottom of the market or try to call the bottom. We're really looking at a medium to long term perspective.